I find relative safety in the H shares and in those internet stocks where you can sort of say, look, there's really good earnings momentum here, the valuations make sense, and you've got that kicker of the AI story behind them.
And Ian, let's get back to the tariff narrative. And if China is on the hook in early April on the reciprocal tariff end, then do we have to downgrade expectations, or is the tech side of the story strong enough to mitigate and offset, and is that big enough of a moat to offset the tariff headwinds?
I think most estimates of the impact of tariffs on Chinese GDP are actually quite manageable. You're talking maybe 50 basis points off of growth. And given that there's such a huge domestic market and so much that Beijing can potentially do to simulate that domestic market, I don't think that tariffs are going to be what derails this very large, actually quite domestic economy.
How do the Trump tariffs affect your positioning globally, sort of moving away, from China, like particularly with the transmission mechanism through what you think the tariffs are going to do to the US dollar?
Sure. There's a few ways that we can protect our portfolios, and it's worth saying, broadly speaking, we remain moderately constructive on risk because policy globally is quite loose, both on fiscal and monetary side of things. But how can you make your portfolio a little bit more robust to nearer term volatility coming out of tariffs? One is focus on sectors that should be relatively insulated from tariffs. So for instance, in the US, it's the domestic sectors, things like banking, where you've got a deregulation impulse, and other things that can support earnings there. Communication services, again, a very domestic segment. We still see a good case for being long dollars as protection, particularly against, say, an Indian rupee, where actually the RBI is already turning to be more supportive on growth, and so you could see scope for more weakening there. And also just within the global economy, being in lower beta parts of the market that actually, even within the US, are still basically at their highs because they're less impacted by kind of near-term sentiment jitters. So those are kind of the ways that you can set up a portfolio. But I think the number one thing to do is just not to overreact to near-term sentiment, because the worst thing that you could do is sort of chase 1 month momentum, sell on negative headlines, because we know that in 2 weeks the headlines could be totally different.